right, we're going to kick things off with a global economic outlook. We're going to look at the West. We're going to look at particularly Nigeria. We've got Afrinvest with us with a new report here, 2025 Macroeconomic View and 2026 Outlook, Stronger Growth, Fragile Fiscal Foundations. Lots to discuss. Damilare Asimiyu is with us, Macroeconomic Strategist with Afrinvest Research and Consultancy. Damilare, compliments of the season.
I wish you the same.
Let's begin our conversation. Always great having you with us to jump into things. All right, so I guess we'll start with the globe. Your reports, I really enjoyed reading it. Very informative. Suggests that there could be some stability in 2026. What would be the triggers for that?
Yeah, once again, thank you for having me on this show. So over the last 5 years, global risk has evolved from what I would describe as global wide risk factor to what is now selective risk. 5 years ago, which happens to be 2020, we had the pandemic, and that had a broad-based effect on the global economy. It had both a health concern, businesses shut down, people were in-house, and until the breakthrough from the vaccine. Now, in the middle of that, global central bank had to inject a lot of stimulus. Estimate put it at around $17 trillion
wow.
globally. So that mass liquidity provided the basis for inflation in 2021. Inflation was spiking, and that ran into early 2022. So as global central banks were, thinking around how to curb demand-driven inflation, which came on the back of the stimulus, then the Russia-Ukraine war began in late February 2022, and that sent oil price soaring. So we then have demand-driven inflation coupled with supply shock, because Russia is perhaps then the third largest producer of crude oil after the US and Saudi Arabia. So that disruption, which also affected key grains, talk of wheat, talk of millet and what have you, because Russia and Ukraine are key producers, then made inflation situation be complicated global-wide. Now, moving down the line, by the end of 2023, central bank globally began tightening cycles to tame inflation, and the positive from that is by the end of 2025, global inflation is already estimated to have cooled down from record 9.7 in 2021 to about 2.2%. But the risk dynamic has now shifted, which is why we said, yes, in 2025, there will be some sort of convergence, some sort of stability, but it doesn't mean risk is completely gone, because across many economies now, you're seeing inflation converging towards a long-term expectation. In the US now, 2.8. Expectation is that to fall to 2% on average in 2026, which is fantastic. But the new risks that now emerged since last year is Trump 2.0 effect, which is tariff.
Yep.
So with the tariff risk, what we are seeing in 2026 is that, yes, global growth will ease slightly. This year, global growth is estimated about 3.2% by the IMF. It will likely ease slightly to 3.1% next year because of some sort of lag effect. But inflation will still converge lower, which is good. But trade will suffer because the tariff is more around trade. And what we have seen is that the US has been able to in quotes, muzzle a number of countries to align with them. So on the back of this, we think that inflation won't be the major issue next year, which is good. So that's why it's removing the global effect. But growth will be affected in selected economies because trade will be affected.
All right. So, of course, I think they heard you to mention trade. So we should have had this already. Let's put up the trade. So with respect to that downside risk to stability in 2026, this is essentially the trade. I mean, you've got, I guess, that's the world, emerging markets, sub-Saharan Africa, and so on and so forth. So is that the number one risk for downside risk for 2026, the trade issues?
Absolutely. Yeah. The biggest risk globally now is geopolitical tension.
Yeah.
And, the sort of challenges we're having is not really around war like what we have between Ukraine and Russia. It's more of weaponization of trade using sanctions. And like I said, the Trump administration used that so much this year, and they've made some gains around it, because if you look at it, the Arab world have committed more than $3 trillion investment plan in the US. Those are the things the US is trying to achieve. Europe have agreed to invest in the US over the next 6-7 years, about 750 billion. So definitely there are other countries that the US is still trying to see if they can muzzle them to reshape their trade relationship with them. So definitely that will be the biggest factor in 2026 to shape narratives. And of course, it also has political undertone. So what we see is that the effect of this will make growth, to vary across board. You can see from the chart, we expect advanced economic growth to flatten at about 1.6%, led by US, which we expect to grow about 1.7%. But you can see that US will have a better growth next year because some of the gains from those trade negotiations will trickle down in the economy. But when you come to emerging markets and developing economies, the biggest economy there that will have a sort of haircut next year in terms of growth is China. Yes, the trade war is part of the drag factor, but also, China has this long-standing real estate crisis. So the combined effect of this will mean that there will be about 0.2% shave off from EMDS growth outlook. And the effect of that is global growth will narrow a bit because US is the biggest economy in the world, followed by China. And when China is having growth much slower than what US growth will be, then it will tell on the overall global economy. But the good thing is that SSA outlook is looking robust.
So far in Africa.
Yes, and that's where we have Nigeria. Expectation is that barring any major shock, Nigeria should also be pulling a very strong growth next year with other countries like Ghana and Cote d'Ivoire. So definitely it will be a selective pattern in terms of what the performance of countries across the globe will be in 2026.
Fantastic. All right, get to, I guess, asset classes now. You've also got a look at how they performed. I just talked about, this is our headline for today, how well gold has performed. Of course, the saying, past performance is not an indication of future returns, right? How do you think, what's the asset outlook for 2026? What do you think? I mean, I'm not going to ask you to put a crystal ball to know what's going to happen because who saw gold performing this way last year? So what do you think as far as next year?
So when you look at this performance, one parallel you can draw from it is that safe haven assets and perhaps risky assets had their way in 2026. Now, the story around gold and silver are very unique. 2025 is a year where most countries intensify effort around de-dollarization. Several central banks ramp up their reserves in gold. Poland build up their gold reserves, the highest this year, more than 84 million tons. Then you have Pakistan, you have China, so what we are saying is that countries across the world, because of this trade tension. So I will link this to my final summary that 2026, we might likely still see the pattern of asset performance mirroring this because of the underlying risk factor, which is geopolitical tension.
And the trade
so as more as countries are trying to reduce their over-dependence on the USD, you begin to see them stock up more of gold. And as that is done, because it's a natural law of demand and supply, the more the demand, the more the value. And you also see that equities came second in terms of asset performance 2025. That's because we moved into easing cycle. I talked about the tightening of monetary policy after inflation hit the roof in 2021, 2022. So because global central banks have now I've seen positive gain in terms of taming inflation. Inflation in the US now has dropped from over 6% 2 years ago to below 3% now. Moving. So equities have become more attractive because businesses now can borrow cheap, expand production, and coupled with the fact that we are having massive investment in the AI segment. So metals, so you can see there's a link between the metals and equities. So risky assets did very well in 2025, and that trajectory might still continue in 2026, especially because of geopolitical tension. However, now, when I talk of risky assets, I'm talking in terms of assets that are fundamentally rooted, like equities. Assets like cryptocurrency or Bitcoin, rather, suffered a major loss. Because the first half of the year was very strong for them in 2025. It was a bubble. And of course, there is nothing that goes up that doesn't come down. So we might see a sort of recovery in 2026, but the optimism around it is not as strong as what you see equities and gold and some other precious metal deliver in 2026.
Fantastic. Up next is foreign portfolio investors. They've meant a lot to us in Nigeria. And I love this chart. Just love it. You've got Africa and the Middle East as top offshore destinations for FPI. So, I mean, do you think that flows into 2026? So, with respect to how FPIs might perform? Yeah,
I think the dynamics will continue in 2026. The question to ask is what drove this huge FPI flows in 2025? Depending on the part of the segment, for the Middle Eastern countries, what really drove it is that there was more of stability in terms of the business environment.
Yeah.
For the African part, it was more of attractive yields and reforms. So you use Nigeria and Ghana as an example. 2-3 years ago, Ghana was in a debt crisis.
Yep.
They've reformed that, got some bailouts, and this has helped their currency as FPIs are coming in. The same thing in Nigeria, the Cardoso-led CBN came in, did a sort of stabilization in terms of cleaning the market, and FPIs have also begun to come in. At least we don't have official numbers of 9 months, but as of Q1, we attracted $5.2 billion in FPI.
Yeah.
That is the highest since pre-pandemic. If you analyze that rate at 5.2, we're likely to have 20 billion FPIs. That was the level we last had in 2020. In fact, close to 2019 level, we had about $23 billion in 2020. Yeah. So meaning that what drove this large interest of FPI to Africa and Middle East is a combination of reform, attractive yield. And when you look at the inflation narrative of outlook for 2026, we are saying that advanced economy will see their inflation drop further. US, for example, the Fed is expected, of course, Powell tenure will be ending in Q1, early Q2 rather. Yeah. We have observed the undertone of the Trump administration. He wants a dovish monetary policy. So definitely the next Fed chairman might likely be one that is a bit dovish to support growth. So definitely with all those dynamics, rates in advanced economy will collapse, and emerging markets will be the attractive ground.
Sweet. All right, let's get to the budgets. President Tinubu is in Nigeria now, presenting that budget on Friday. Your report, you looked into it. What's your, take on the budget? And maybe I don't know what to get into the assumptions, but just a general your thoughts on what we expect on that part of the budget will perform for 2026.
Okay, so my opinion will be splitted into two. Yeah. I'll speak on the pros and the cons. The pros of the budget presented last week by President Tinubu is that the assumptions are more realistic than 2025. We talked about oil production of about 86 million barrels per day versus 2.06. It's more realistic because as of 2025 that is ending, the average production about 1.66 million barrels per day. So it's easier to move. And in 2025, we're around 1.51. So we'll move from 1.51 in 2024 rather to 1.66. So you look at the gap that was covered in a year, you feel that we might likely be ahead even if we are not reaching 1.86. 2025 budget was put on a very ambitious expectation. The same thing, oil price at $64, very close to what it is now. Inflation, of course, following the rebasing at 16.8, the assumption is fine. Now, where I have issues with the budget, which is now the cons, is the large fiscal deficit. 2025 budget was a 55 trillion budget, revenue projected at 40 trillion. As of 9 months, based on the president presentation, we've only did 18.6. So if you analyze that, revenue is not going to exceed 24 trillion. Yeah. All else equal in a base case. Now, meaning that if we max out the budget, of course, there's a problem of rollover. We are not discussing that. Meaning that if we max out the 55 spending, our revenue will not even half the deficit. Yeah. So now we're going into 2020. Now, the deficit that was budgeted for this year was 9.3 trillion. After the budget adjustment, it moved to 14.1. So from 14.1, the reality before us now is that the deficit might likely be in the region of 20 trillion or more. So in 2026, the proposed budget is showing deficits of 23.9, meaning that our deficit is moving at a compounding growth rate. This is not good. this might be an issue,
especially
if the revenue side of the budget is not well tightened. But in terms of expectation for revenue, 33 point something trillion, it looks a bit more realistic than 2025. But we all hope the best for our country, and we think the president will be able to deliver on this.
Okay, but now what about oil? You've got a chart on performance. Look at Brent and
absolutely.
And these are precious metals are performing and then cocoa and so on. So I know we've been talking a lot about non-oil revenue, the non-oil economy and so on and so forth. But with Brent underperforming, and I guess you give me your outlook for oil next year. What's that? That's a challenge for us on the revenue side, is it not?
Absolutely. Yeah. That's a challenge. You recall some few weeks or months back when I discussed the half-year report with you. I mentioned it then, even before the budget presentation came out, that based on our estimates, oil revenue, which was supposed to account for 21 trillion this year, which is about 51.3% of 2025 budget, had underperformed by no less than 20%.
Ouch.
So when all these revelations were coming out, it was just giving credence to that, because production was low, price globally was also below our budget benchmark. Even though we have set a $64 benchmark for oil this year, there is still concern around meeting production. Now, when you then look at it on the global scale, the outlook for oil is also not very bullish. The IEA, which is International Energy Agency, is looking at oil within even 56 to $60. That's even more pessimistic. So, should there be further pressure on oil price in 2026, Nigeria will be in chaos, because we have three major sources of FX to Nigeria: oil, crude oil, top that chart, followed by remittance and FPIs. And that is why I'm of the opinion that irrespective of whatever has happened to our inflation, quick deceleration, our yield will not decelerate that quickly, because the FPIs have been the secret tactics of the CBN to keep FPI attractive rate, rather, to keep them here, which is helping to support liquidity and making the naira stable. So oil is under pressure, and we hope the pressure will not go more than this, because a further worsening of this, I mean, look at the 9-month budget. Pro rata revenue was supposed to be 12.4 trillion. We only did 4 trillion. That is underperformance of 62%. We can't afford to have that kind of experience in 2026. It's beyond our control. But then, it then means that the government needs to tighten their belt and be more innovative.
So tightening belt is cutting spending, one. Two is taxing. So we had Taiwo Oyedele on our flagship morning show, and he was kind enough to give us the tax reform acts here. Is Nigeria going to be more? I mean, we know the tax laws are going into effect January. Nigeria going to be more aggressive with tax collection and taxing wealthy people in 2026?
Of course, there's a saying that when the desirable is not available, then the available become desirable. The desirable will have been for Nigeria to pump more oil, make more money from oil, improve non-oil exports. Now, we said even the government in their template for 2026 already has seen 23.9 trillion deficit. That is more than actual spending in 2023. 2023 actual budget spending was about 23.4 trillion. And that is a figure bigger than that is what we are expecting. And I've given the precedent I've given. There was no year we didn't overshoot our deficit. So for the government to be seeing 23.9 trillion deficit, you can almost project that actual deficit might be 26 trillion, which is catastrophic. So definitely when the desirable is not available, which is making more money from oil, non-oil exports, what have you, then tax might be the last resort. And to a large extent, tax and borrowing, they seem to have almost the same effect, just that one is postponing the pain for the future. If you borrow, it's the future generation that will pay for it. But if it is tax, it is people now that will pay for it. So if we are the one that elect this government, we are the one working with them, I think the tax route might still be the option for now. It will then make us to press them to be more accountable in the usage of it. Because when you even look at the debt numbers too, it's staggering. As of 6 months, which was the last number we had a total debt profile at 152.6 trillion. Yes, with the GDP rebasing, that puts up about 38%. But if you had this projected one and the full estimated for this year, we are also moving back to that level where our debt sustainability metrics is in the red flag again. So definitely, we're likely to see the government being aggressive with tax next year. But the usage of the proceeds should be justified.
Gotcha. Inflation, we saw a deceleration in 2025. NPR, we saw this, hawkish, and then there was one cut to 27%. How are you seeing, I guess, inflation and monetary policy path for Nigeria next year, 2026?
Yeah, so the CBN will maintain cautious stand next year. What I meant by that is, irrespective of what the inflation number is reading, the CBN decision might be a bit tilted away from it. Now, one of the reasons for that is what I've mentioned. The Cardoso-led CBN government is very interested in price and exchange rate stability. Yeah. And one of the reasons why we have had exchange rate stability this year is the FPI, guys. The moment we crash our rate too much, you can see the last meeting, they didn't cut rate. They only took the asymmetric corridor to force bank to lend to prime lenders. So because you need to be very attractive. Now we also have the issue of around CGT that will take some charges from people. If you then cut your rate aggressively in the middle of that, FPIs will depart the country. And we can't afford that. We can't afford that because that will mean an immediate pressure on the naira. So definitely, given high rebasing effect and some other dynamics, we might see inflation. Of course, we are expecting December to be a bit spike, maybe 28 to 30% because of the base effect. But from January, it begins to normalize again. But irrespective of that dynamics, the CBN will be very cautious with rates. So at base case, 2026, barring, and there is also political risks, political spending from media. So if the CBN is able to, if the political spending is being curtailed, such that it's not pushing too much liquidity in the economy, then maybe the CBN might be doing between 100 and 150 basis point cut throughout the year. Yeah. But in the event political spending becomes very aggravated and liquidity is high, the CBN will maintain a lead on policy rate.
Damilare Asimiyu, it is always an absolute pleasure talking to you about the economy because you are so illustrative in your descriptions here. Thank you so much for your time. Of course, Macroeconomic Strategist with Afrinvest Research and Consulting. Thanks for the report. It's great. I want to wish you a Merry Christmas, a Happy New Year to you and all the staff at the Afrinvest. And we're going to have you in 2026, right, to continue the conversation.
Thank you very much.
Thank you, Damilare.